Markets rallying on that weaker than expected jobs report out of the United States, and that has sparked hopes once again for Fed rate cuts before too long. The US added 175,000 jobs in April, well below what economists had predicted. We're joined by Grant White, portfolio manager and investment advisor at IA Private Wealth. Grant, great to see you. I know it's just 1 month, but investors certainly apparently happy to see this jobs report.
Yeah, we'll take it, Andy. I mean, it's a nice report, and obviously with what we've seen more recently in the last number of weeks, especially, it's a little bit of a relief for a lot of investors out there who are hoping to see some rate cuts this year out of the U.S. And so, Jay Powell calmed things down a little bit earlier in the week, which was nice. But this jobs report is going a long way today in helping people to feel a little bit more comfortable. And looks like the markets are hoping for anyway, 2 rate cuts out of the U.S. again this year. So we'll see if that happens.
What about Canada? Are we going to be getting rate cuts pretty soon here?
Well, I think so. I mean, I think that we're going to be a little bit further ahead of the U.S. in this. We're still thinking that likely we'll see a cut in June, and then we'll see where it goes from there. So I do think it's more likely at this point. I put a higher probability on Canada dropping rates certainly earlier, as most people would. But it is looking like the U.S. might follow shortly thereafter if the data continues to improve. Like we're seeing here. And this is a very data-driven Fed at this point. So it's a wait and see on that.
What are you telling your clients about getting into bonds or these high-yielding dividend stocks that people sometimes take as substitutes for bonds? Is it a good time to be buying those right now?
Yeah, it's interesting. I mean, heading into this year, I was telling investors that this was probably the best environment for investing in bonds that I have seen in my entire career. And I still believe that, but the market is definitely making us wait longer than I would have hoped for that. And we're seeing more volatility than I would have hoped. But in saying that, I still think this is a really great environment. I mean, we're certainly getting paid to wait on those rate cuts, and that's a good thing. So bonds have probably been, like I said, the best I've ever seen in my career, dating back before 2008. I'm a little cautious on the higher dividend-paying stocks because I think you got to dive deeper on that. I think people get trapped into yield traps with dividend stocks sometimes, and not that all high-yielding stocks are bad, obviously, but I think you need to be careful. You got to dive into them a little bit more and find out how those dividends are being paid. So I'm a little bit more cautious there, but I still like the environment for bonds, certainly.
We're going to be talking shortly about at least one high-yielding pipeline stock. What about the rest of this year? I mean, it's never plain sailing for the markets, but is there a threat that you see right now to markets?
Oh, yeah. I mean, I think at the end of the day, these markets are going to be volatile. And it's not uncommon as we go through these cycles to see 10 and 20% pullbacks in the markets. And so, I mean, we've kind of gone through one more recently, but, if we've already turned the corner on it, it really wasn't that bad in April. So I do think that investors need to be cautiously optimistic at this point in the markets. I think the trend is going to be higher. I like the way the markets are going. I love the breadth that we're starting to see in the market returns. This isn't just being led by the Magnificent Seven or the top, the largest companies anymore. And so that's a good thing. But I do think we're going to see lots of volatility like we've seen over the last month. And so investors need to be prepared for that. I think there's lots of opportunities in these markets at the same time, and be ready to buy in when you can.